Capital webinar on investment considerations for US connected persons. I'm Simon Reed. I'm Executive Director in the Private Investment Office team, and I'm joined today by my two colleagues, Matt Farrell and Tahir Mahmood. Tahir is our Head of Client Management in our US team and is our specialist UK and US tax advisor. And he's going to be walking us through some of the key considerations as well as some practical examples when it comes to investing for US connected persons. Matt Farrell is our investment director, sits on our investment team, and continuing the US theme, however, he's going to be giving us some macroeconomic views with regard to the US strategy and markets. This will then be followed by a Q&A session, so please feel free to add your questions into the chat box below, and we will do our best to answer the questions for you at the end. So with that, I will hand over to Tahir for some of the technical aspects of investing and taxation relating to US persons.
Thank you, Simon. So just as a brief introduction, I have trained as a US and UK tax advisor. I specialise in high net worth compliance. So I understand the problems that Americans living in the UK face. I moved on to residency after that, so a lot of the statutory residency test, physical presence test, and moving globally mobile internationals across the world. I joined LNC about 5.5, 6 years ago to act as midpoint between the accountants and the investment guys, and now I mainly look at structuring our portfolios from a tax efficient perspective. So before we jump into the first example, I'm going to be fairly quick with this because I've got only about 15 minutes. So I know it's about US tax, so I'm going to do the basics of US tax first. You're all probably quite familiar with how it works, but just a quick overview of the main points. Ordinarily, countries tax based on a residency system like the UK. So if you're present in the country for a certain number of days, you'll be taxed there, but of course this depends to your ties to that country. 183 is the normal amount, but this can drop to somewhere as little as 45, depending on if you've got family, a home to live in. And the US, it doesn't go by these rules at all. It's one of 3 countries in the world that taxes on a citizenship basis. So if a US citizen moves somewhere like Dubai, likely they'll still have to write a check to Uncle Sam every year to pay the US tax due on their foreign income. To make matters worse, the US then imposes extra taxes if you invest in funds not approved by the IRS.
Tahir, just on the investing in funds, could you elaborate a bit on what a PFIC is?
Of course. So PFIC stands for Passive Foreign Investment Company, similar to the offshore income gains rules we have in the UK. So any offshore investment the IRS cannot see directly into, something like a UK-based ETF. What they do is then they charge income at the top rate of US tax, charge interest and penalties from when you first invested, and then more interest on any overdue tax. But this is then capped at 100% of the investment, so you wipe out all the gains you make. In essence, all a PFIC is just the IRS's way of looking at foreign investments. It's looked at so penally because the way that they tax it is just all the top rates of tax. So I thought I'd push on to the examples quite quickly. Can we go to the next slide, please? Thank you. So US tax is quite expansive, so I'm going to do 3 topics and I'll run through them fairly quickly. So the first one being how currency affects the sale of assets. So running through a quick example here, in 2005, Sarah bought an investment property in New York for $1 million. At the time, the FX rate was 1.8, so the pound cost was, I think it's a little bit over £550,000. She's now planning to sell the property for $1.3 million. FX rate today, or close of business yesterday, when I checked, was 1.25, which gives a pound value of just over $1 million. So looking at these numbers, you can see the US gain is 300,000. You've got no No currency there, it's just the actual appreciation of the property. US tax, 20%, so $60,000 of tax. Unfortunately, the UK would tax you completely different. They look at everything from a pound perspective, and they'd say that the gain is your 1.04 less the 550,000 costs. So you've made a gain of 490,000. So this is all to do with the FX rate fluctuation. And then to compound matters slightly, UK tax on investment property is 28% at the top rate. So effectively what's happening here is you're paying almost an extra £100,000 to the UK authorities just because you're resident in the UK and because of the FX rate swings. The same goes for assets as well. You need to look at the FX rate and the date of purchase, and then again at the date of sale. Could I have the next slide, please? Thank you. So the next section is account structuring for an individual on the remittance basis. I'm not sure if you can see the flow chart there. I can just about make it out. But again, another example. If we had an American citizen who'd been resident in the UK for 10 years, they originally came to the UK with a clean pot of money and would like to have this invested tax efficiently. So if they've been resident in the UK for 10 years, they get the first 7 years free, well, they get the remittance basis charge free, which means they're only taxed on their UK sourced income and anything remitted to the UK. There's no charge to that. So most non-DOMs, it's not just Americans, non-DOMs get this opportunity. They would take that up. Once you go past the 7-year window, the next few years are charged at £30,000.
And to hear the rule changes in 2017, perhaps just a word on how that affects things.
Of course. So the rule change is a little bit trickier because in April 2017, as you said, HMRC brought in a rule and said, once you've been in the UK for 15 years, you no longer have this opportunity to go on the remittance basis. So this flowchart underneath, which I'm about to go through, does not apply to those people. It used to, but long-term residents now are just treated as if they're normal British citizens and they're taxed on the arising basis. So running through this example, if we use round numbers, the clean pot of money the American originally came to the UK with was, let's call it £10 million. What we do with that is that would get all invested into the left box, clean. It's pre-arrival income. So pre-arrival funds, so all clean, can come to the UK without any charge. Once that's invested, let's assume a rate of 5% to make it easy. That would generate £500,000 of income every year. That would get all paid directly into the income account. So now we've got two pots. We've got your 10 million in the clean, 500,000 in the income. You make one further pot called the mixed gains, because you cannot separate out the gain on the sale of an asset. So if you bought something for, let's say you bought Apple stock for $100, and then you sold it for $110. We know the original 100 is clean and the 10 is gain. You can't separate out that gain. So we need to move the full 110 using the orange line at the bottom. That would go into the mixed gains portfolio. So the reason we structure like this is so we can bring money into the UK from different pots. If the American citizen decides he wants to buy a house in the UK, if the money from the mixed gains of the income account came into the UK, there'd be an additional tax charge. So we've still got the clean pot, and we can say that can come into the UK without any charge. Could I have the next slide? Thank you. So there are several ways that a foreign trust can get pulled into the US's net of taxation. The most simple one is a US citizen sets up a Channel Island trust. The trust is considered completely transparent from a US perspective, and it'll be fully taxable to the individual. So the trust needs to be structured to meet your individual requirements. So no PFIX, making sure we've got short-term, long-term segregated. That's the most simple one, but I'm going to run through something we see more commonly. And this is a regular Channel Island trust and one beneficiary moves to the US. It's normally okay at the start when we're told about the beneficiary moving to the US, but the problem arises when the beneficiary has been in the US for 2 or 3 years. You've got a big pot of UNI, so that's undistributed net income, that's sitting within the trust. So before I run through this example, let me just clarify what UNI is. It's undistributed net income is defined as the distributable net income less income required to be distributed and any taxes imposed on the trust. So if you had a trust had income of 100,000, 30,000 was required to be paid out to beneficiaries, another 20,000 went on taxes, the remaining 50 that's held back in the trust is UNI. So I suppose a lot of normal Jersey trustees or offshore trustees without US links would not see this as an issue. It's just an accumulation of income within the trust. Problem is, from a US perspective, UNI is taxed as PFIC income, or very similarly to PFIC income, and you'll get the throwback taxes, and it just adds up. So you won't get the beneficial current year tax rates. So running through this example, we have a Jersey trust with £1 million of UNI, £5 million of trust corpus, and 100,000 of current year income. So what is the issue? It's the US linked individual. It's as simple as that. They are the ones that are bringing this into the IRS's net taxation, and it means it needs to be, the whole trust needs to be managed for this one person. So you could have the whole house, you could have 20 beneficiaries, and then one person decides to the US, go to the US. You would then need to change the structure. So in this situation, how would we rectify this? In the first year, we would set up a mirror trust to park the dirty money. So the 1 million of UNI and the current year income, that would be parked off to a separate account. So we'd have the 5 million main portfolio and then 1.1 million separate portfolio. This clears all the historic UNI. We do that because we don't want the US person to be benefiting from any of the UNI or distributing any of that and getting the additional tax. Once the UNI has been moved to a separate account, we need to manage the whole portfolio in a tax efficient manner. So distributions to the US person only come from the main trust. And then the UK beneficiaries can take their distributions from the mirror trust because they don't get called by the UNI. Then once all of that's sorted out, you have the ongoing management of the trust with the US linked individual. You have the reporting. So US trusts require 3520 filing. It's an international form, and it's informational form, and it's similar to FBAR reporting. So we just need to go through and fill in the information. We at London Capital, we can provide you with a tax report that details all of this. So you can just pass this on to your tax advisor and they can fill this in. Along with that, we manage the distribution. So if the trustees came to us and said we need to make a distribution of X amount to the US trust or the US beneficiary, we would go through and prepare that and provide them the most efficient place for this to come from. I think that is all I had to say.
Great, thank you very much to hear. At this point, I'd like to bring in Matt. So continuing the US theme, but on a macro focus. Matt, if I could open with a question. The US economy, very often seen as a bellwether for other Western economies. Where do we see the plotting of the recovery, and what's our outlook for the US?
Okay, morning everyone, nice to speak to you. So I guess what we could say from a positive sense is we're probably past the worst. Obviously we're in the COVID shock and supply demand, we were all aware of the impact there. Q2 is going to be a very severe contraction. We'll get the numbers shortly. Probably not going to turn out to be quite as bad as some expectations were originally. So it was some forecasts were of the magnitude of almost minus 50% on an annualized basis, quarterly annualized basis, but it's likely to be slightly less than that. But nevertheless, this is still going to be the sharpest contraction post-war. And then subsequently, we're going to expect a fairly robust rebound in Q3, and that's going to come because of the very low base. It's going to come because of some of that pent-up activity spending that comes online as we unlock, and it's not just the US, this is globally, unlock economies. And that's starting to sharpen the data already, whether that be the tracking of mobility and sort of more high frequency data showing that people are going back to their normal activities, or some of the data that's coming through in terms of spending. So if you look at consumer goods spending in places like the US, it's moved not back to the levels which was in January during May, but fairly close to. And in June, that data is expected to come on, actually probably maybe surpassing sort of levels of consumption where we were in January. So in that respect, that's the good story in terms of the start of this recovery. However, I don't think we should get carried away. Some of that is inevitable. Like I say, that pent-up activity is going to be flattering to those initial numbers. And really where you start to become a little bit more skeptical and think that this recovery trajectory, when you talked about the pattern is going to flatten off, is going to come in subsequent months, second half of this year, most likely. Reasons for that? Well, firstly, consumers, businesses, and governments. Government is going to have to make some tough decisions. We can't lock down economies for this period of time, the US economy for this period of time, and then expect that things are going to rebound to where they were without consequence. Households are going to be more stretched. Businesses are going to be more stretched. I think that one of the key things here is that, given the huge amount of policy that's been rolled out in the US to support incomes through this period, through necessity, there is a reliance on that. In fact, actually, when you look at household income, it's actually on aggregate being boosted through stimulus checks, through enhanced unemployment benefits, and so on, all the programs that have been laid out. So there is a dependence on those. And if we get into the second half of the year and unemployment, the unemployment we're seeing is less temporary than most people hope, then there's going to be a shortfall, because those income programs aren't going to be in place indefinitely, certainly not at the levels. With negotiations are in place at the moment to extend some of them, but the generosity of them is going to be lower. The stimulus checks are going to be more targeted, the enhanced benefits are going to be lower. Some people might not even, in the self-employed sector, might not even get the benefits that they're getting now and had through this period. So, wrapping it all up, and we haven't even talked about kind of what problems the virus can cause. Yes, this is a rebound. We're in a recovery. We're past that point of maximum uncertainty. But from here, we shouldn't get carried away about continuing the steepness of that recovery. and it's likely to flatten out quite considerably, given some of those concerns. We just touched on a couple of them. But tracking those unemployment trends and the developments there is going to be critical, because this really has been very disruptive to the nature of unemployment and in terms of magnitude as well.
Matt, just before I ask you a quick question, just a reminder to everybody, we've had some questions come in, thank you very much, on the chat box, so please feel free to keep those questions coming. We'd love to be able to answer those for you. Matt, clearly there's going to be a degree of uncertainty around the upcoming elections in the US, and how do you see that affecting things?
So yeah, probably, obviously with all elections, I mean, most developed market elections, you usually historically have thought that they, in the short term, they may be important, but I've always been a believer that economics move politics rather than politics move economics in developed markets anyway. But this could be different because obviously Donald Trump has had a very significant influence on relationships globally, but then also on stock markets and asset prices. And you're quite right. I mean, in terms of it being disruptive, this might be on the market's radar earlier than it would normally be. A lot can happen between now and November, but the margins that are starting to open up, not just in terms of Biden to win the White House, but then also for the Democrats to flip the Senate, and then for have a clean sweep in all of government. The margins are open up to a point where it becomes an uphill struggle for Donald Trump to make back that ground. So it could start to weigh on markets earlier than we would eventually think. So then we've got to think about what does a Biden presidency mean? What does also potentially what does a Biden and Democratic Senate mean as well, a dominated Senate? The first thing that we're going to be on the market's radar is tax policy, corporate tax policy. As you remember, back in 2017, where we got those big corporate tax cuts, somewhere I think it was 35 down to 21. Very inflationary, good for company earnings, good for US stocks. And Joe Biden has indicated that, and the policy as it stands is that he's going to roll some of those back. So you're going to see corporate tax rates increase. Clearly, that's not going to be good for market sentiment in US equities. What's key here is if he's able to flip the Senate. He's unlikely to be able to ensure the smooth passage of that sort of change if he doesn't have the Senate. But that's probably the key thing. The other things, maybe from a corporate perspective, we've got to be mindful of is that, and from the Democratic Party, is they're going to be pushing for lower income wage increases, and that's going to potentially pressure company margins at a difficult time already. He's going to most likely roll back some of the regulation changes that Donald Trump has put in place, especially around the environment that have been put in place over kind of the last 4 years from Donald Trump. Net, this is probably a market, equity market negative. There are good things that come with Joe Biden, more stability in relationships. There's going to be infrastructure spending that was unveiled just last night in this speech he made. So some good things in terms of growth and inequality, resolving those problems. But I think in the short term, it threatens to be something that's going to be another disruptor to kind of asset prices. And as I said, maybe earlier on this time round, given how important that's going to be, the climate we're in, and the margins that are opening up. So just to put it into some sort of context, if you look at betting odds, it would give Biden a 60% chance of winning the White House and roughly about the same for the Democratic Party to take back the Senate. If you look at Donald Trump's kind of popularity, it's down at the levels at this point in his tenure, similar to George Bush Senior and Jimmy Carter, and they were both one-term presidents. So the tea leaves don't look particularly good for Donald Trump at the moment, and so the market's got to factor that in.
And you touched on it there with assets and just the effect that may have on asset prices or the varying outcomes. Any more thoughts on that? And also two questions in one really. And the US dollar, what's our outlook for the dollar?
Okay, so obviously this is going to be some short-term turbulence, especially if all those things fall into place with the Biden presidency. I think obviously US assets are going through a period of flux. We see that in markets on a daily basis. Sector winner losers. Differences across countries now. So if we look reflecting on how important US assets are going to be, that's not going to go away anytime soon, especially when US stocks are dominated by tech, and there's large absence, especially in the developed world, of significant tech names elsewhere. So when we look to the UK or Europe and so on, so the reliance on or the flows into US equities may be disrupted because of the tax policy, but at the same time there is a clear winner that's coming out of this, or accelerated winner, which is technology, and that will benefit US stocks. But obviously this COVID shock has come with consequences for growth and interest rates, and what we've had is, coming into the COVID crisis, we had a period of, many people would describe as kind of US exceptionalism, because growth rates were higher than the rest of the world, or the rest of the developed world. Interest rates were moving up, so they have this growth and interest rate differential that was beneficial to flows into US assets. Keeping US assets in the US, but then also attracting international assets into the US at the same time. And that was obviously fed some of that dollar appreciation, that the stronger dollar that we saw pre the COVID shock. All of that's been reset. So interest rates taken to zero, growth obviously under pressure, and what we're seeing now. So some of that exceptionalism will fade, and the benefits of diversifying for we're talking about US persons probably increase from here, given that reset and that kind of fading exceptionalism. But then also, I think that we've got to think from a current. If you want to talk about currencies, those tailwinds for the dollar have faded, and what you usually get when you go through these economic contractions, and then you get reflation and a global recovery, is that usually translates into dollar weakness. Not only do you not have the dollar tailwinds, but then we're also entering into a kind of a climate globally which will encourage dollar depreciation over time, and over that, certainly as the recovery gains traction. So I think US assets are always going to be attractive because of how dynamic the sectors are and the things that are in play. I think the US as a country becomes marginally less attractive from an asset and a currency perspective looking forward, especially if US investors are thinking about diversifying. And then lastly, I think where they're going to go. It's not just about the weaknesses of the US. I think probably one place that's deep enough and that offers enough value at the moment. People will start looking inevitably towards Europe. I think it's early days, but on several fronts, they look to have done a better job than the US in handling this crisis from a healthcare perspective. The policy response has been very robust, monetary policy, but then also we're now talking about a more coordinated fiscal policy, co-liability bonds potentially. We'll find out more about that this week. That is could be a big game changer for Europe. And then you have a period where European asset prices on a relative basis are cheaper than the US. They don't have all the attractions, but there's certainly more going for them than the previously.
Great. Thank you very much, Matt. I think we can go now to some Q&A. Some questions have come in. Matt, perhaps to give you a little bit of a break, one for Tahir, where have a client who wants to bring money into the UK, but it's all mixed. So one issue. Then can I take a loan against the portfolio and remit this?
Sure. So just before I go into this, I should caveat that we're not tax advisors. So what we do here at London Capital, we give tax guidance, and working in the tax industry, I understand the US UK piece very well, but we always work with the accountants as well for them to get sign off. So on your question, if they want to bring the money into the UK, can they take a loan against it? We need to be careful on this issue, because the HMRC will see any remittances into the UK via a loan as an indirect remittance. So that if you had a completely mixed offshore portfolio, let's say worth £1 million, you took a loan against 600,000, bring the loan money into the UK, HMRC would say that as a full remittance into the UK of the underlying funds. Therefore, you should not do that. So that there's ways to work around this that we can look at, but definitely not.
Okay, thanks Tahir. And another one for you, I think. So we get the primary principal residence exemption, I should say, in the UK on UK property, and how does this work on the US side?
That's a really interesting question, actually. So PPR in the UK, it is on the full sale value of your property, on the basis that you lived there for the entire period. So with the appreciation in UK real estate, I had a client probably 2 weeks ago who bought a property in Dulwich maybe 20 years ago, and it's gone up fivefold. So they've made a £4 million gain. The £4 million gain is completely exempt from a UK perspective, but they're both American. So they do not get the PPR in the US. There's something called a Section 121 exclusion. They get $250,000 of exemption each. And what makes it worse is you have to look at the dollar amount as well. So the dollar value at purchase, dollar value at sale, less your 500,000. So they're going to end up with I think it was close to a $400,000 US tax liability on something they weren't expecting at all.
A question here for Matt, I think. With all the central bank money printing and flow of funds, how do we see that affecting inflation down the road?
So obviously what we're seeing in the short term, because of lockdowns, because of the impact on, as I say, anticipated impact on consumption and investment spending, etc., is we're experiencing a deflationary shock. You know, that's what's going to happen in the short term. That's without doubt. That's probably going to last a good couple of years, given the output gaps that are going to open up and unemployment we're going to see. So the near-term prospect of realised inflation is pretty low. But yeah, it's clearly, given that we've gone into a kind of new stratosphere of central bank policy, and now we're seeing more coordination with fiscal policy. So something we didn't see post-financial crisis as much. It's raised these questions about central banks are expanding their balance sheets so significantly, and the dependence on them is going to be even greater. Is this going to translate into inflation? Well, I would say that the similar kind of concerns existed when QE first became more mainstream after the financial crisis, and they weren't realised. You know, there's clearly secular issues going on that have weighed on inflation over the last 12 years, whether that be debt, demographics, globalisation, tech, things that have been unsettled somewhat by the COVID shock, but that clearly aren't going away. So we shouldn't necessarily believe that we're going to get inflation coming through very, very strongly. However, there are some things a little bit different this time around that's probably worth highlighting, and probably to investors, ourselves included, being a bit more inflation aware of that risk. The first is that the banks are in a lot better health than they were in 2009, and that's important because central banks can create money, but commercial banks can destroy it. And they're the channels to the real economy in terms of lending. Whereas back in the financial crisis, that was taking place. Fewer loans, deleveraging in the banking sector. That's the root of all the problems. This time around, the banks are in far better health, and are going to be far stronger conduits to the real economy, and they're being encouraged to do that on a daily basis to rescue the real economy because of what we've seen. So that's the first difference. Second difference, marginally, I would say, is globalisation. It was already underway, but I think that one of the consequences here is going to be more onshoring, certainly with sort of strategic supply chains, bringing them closer to home. That's going to likely lead to price increases, and just in the same way that globalisation lowered prices, it should start marginally increase prices. So there's two key things, and then along with kind of the quantum of monetary policy definitely there is an elevated risk. But I don't think we should be losing too much sleep in the short term about this, and also short term the next couple of years, because there's, as we said at the beginning, there's going to be a lot of economic consequence. What we're seeing is not all being kind of recognised at the moment, but disinflationary forces is going to be one of them. Bond yields aren't as low as they are because they're fearful of inflation. There is a lot of central bank buying that pushes yields artificially lower, but I think in some part they do still tell us something about inflation expectations.
Just staying with you, Matt, questions come in. Are equity markets overdue a sell?
Certainly, I guess we talk again about monetary policy and liquidity that's been added to the market. Lots of people will recognise, ourselves included, that there is a dislocation, but at the moment it seems, between progress being made in the recovery in asset prices and the levels and valuations that we've reached, certainly in certain sectors, and what's happening in the real economy. At the beginning, we weren't painting a particularly encouraging picture about economic prospects and the shape of the recovery. But equity prices are either looking through that and are far more optimistic. That's what they tell us, or they're operating on the function of something else. And I think it's more likely than something else, which is that huge amount of liquidity, capital is trying to find a home, and it no longer can find it in government bonds, certainly in a rewarding sense, far lower in lots of other parts of fixed income, and it's being displaced. That liquidity is flowing into areas where you might get growth and for the future, and on a relative basis, it's more attractive, and that's equities. And we don't think that can continue indefinitely. That at some point companies become corporate prospects are a function of earnings and earnings growth and the outlook, but it's continued for quite some time. So our belief is that yes, there is potential for I think the question was described as a kind of a sell-off or whatever it was, but the momentum that's being created by those capital flows, by this liquidity is significant. So it could defy our expectations for quite a bit longer, until we really hit some bad news on the virus front, on the economic front that becomes more evident, or potentially policy. We find that there is, after this initial surge in policy, fiscal and monetary, that it starts to become more modest, more measured, and that excess liquidity tapers off a little bit.
And a quick one for me, actually, just off the back of that, Matt, is kind of as an extension. What's our view really on credit fixed income markets in the US?
Yeah, so obviously the collapse in yields has been very supportive. We had lots of dislocations during the worst sort of time in March and April because of the liquidity situation, the market operation of fixed income. But subsequently, with the policy response that's normalised those issues or eased the pressures we've seen, fixed income volatility, government bond volatility really compressed, but we haven't seen that necessarily in equities. So from that perspective, there's been a return to normality quicker. And then you also have these a very active, motivated buyer now across lots of spectrums, whether it be government bonds or corporate bonds or even high yield via ETFs in the Fed. So there are supports. We're going into a low growth and low inflation environment, which again conventionally should be supportive, at least constructive for fixed income. Naturally, people will say that given where yields are now, the opportunity set is slimmer, and that's in reality that's been the case for some time, and that's why you need to take a selective approach. Fixed income is a big spectrum of different asset classes, really different risks and sensitivities, and characterising all US bonds as one doesn't really give it enough credit. I think investors have to take a very selective basis where they are rewarded. They harness those supports that are in place, but they're still rewarded, and they're probably likely to come in credit, essentially. And in our case, quite favour financials as well.
Thanks, Matt. And finally, just being conscious of time, Tahir, I have a question here. Thanks for you. What's the view on relinquishing green cards at the moment? If it's no longer needed, is it better to give it up?
So relinquishing green card, there's still an expatriation tax. So it really does depend on the individual's situation. Are they above the 2 million mark? Surprisingly, I thought we'd see more of this because the depressed values in the stocks, people are saying, yeah, my total net worth has fallen below a certain value, maybe I should give it up. But whenever I speak to US citizens or green card holders about holding it, they don't want to give it up. They like to have the opportunity to go back to the US. I've not seen anybody do it at the moment. So if it really is a personal choice and depending on an individual circumstances. So I'm happy to have a chat with the person who's asked the question, and we can look through the facts and figures to see how long they've been in the UK, if they're up to date with their filing. That's another requirement of relinquishing a green card. But definitely worth looking at with depressed values in the assets at the moment.
Okay, thank you, Tahir. And we've hit our 45 minutes, and so I'll draw the webinar to a conclusion, but just to say thank you very much to all of you for joining us and for all your questions. Thank you to Tahir and Matt. And if you have any further questions or follow-up questions, we will be sending an email. You'll have some details on there to be able to get in touch with us, and we'd love to speak to you further. So thank you again, and from all of us at London and Capital, have a very good day. Thank you.
All the best.